Thank you, everybody. I'm Rich Karlgaard, publisher of Forbes. One of the great things about working at Forbes is you get to go to Singapore a lot because Forbes Asia is headquartered in Singapore. And having traveled to Singapore probably 2 or 3 times a year over the last 20 years, it's not only seeing this great city become an even greater city, but it's also seeing the rise of Southeast Asia. And we often don't think about Southeast Asia as a unit. As Nick Nash will tell you, you think of it as almost like the European Union, but it's near 700 million people, rising affluence, growing at about 7% a year when you look at all the countries in the ASEAN, under the ASEAN organization. And it's quite potent, and it may become even more potent now that Western companies are rethinking their relationship with China. So we have a great panel. We have Nick Nash, who's the co-founder and managing partner of Asia Partners, which is a investment firm investing in sort of mid stages, and he'll tell you more about it when he speaks. He was also the group president of C. C is a Singapore company that went public on the New York Stock Exchange, and today it has a market value of $24 billion. So it's the largest publicly traded company out of Singapore in this digital space. Next to him is Woon Lim, who's the managing director and deputy head of equity at Daiwa Capital Markets America, where he directs 300 institutions and exposes them to the opportunities in Southeast Asia, not just Southeast Asia, but a lot of Southeast Asia. And then we have Amit Saberwal, founder and CEO of RedDoorz. RedDoorz is a budget hotel network. It kind of exists between traditional hotels and Airbnb, but something that you wouldn't recognize as a model, a comparable model in the United States. And it shows you, the importance of understanding the local culture. His company is headquartered in Singapore, but they've really rolled out RedDoorz in Indonesia. And then finally, Oskar Miel, managing partner of Rakuten Capital, corporate venture arm of the Japanese e-commerce client, based in New York, but does a lot of investments in Southeast Asia, particularly around fintech and mobility. Nick, I'm going to start with you. Give us sort of the 2 to 3 minute macro pitch for Southeast Asia and why you're so excited about it.
Rich, thanks so much for convening this panel. I really appreciate the opportunity to be here and bring such a great group together. The beautiful thing about Southeast Asia is that if you think about the 3 things you want to have as an investor in any part of the world, you want a terrific underlying growth opportunity. You want very, very strong quality of management in terms of their ability to execute at scale. And ideally, you also want to have businesses that aren't so hyper competitive with each other that they actually can't get profitable. You want a good profitability profile. And I would tell you hand on heart, anywhere in the world right now, the question is not getting all 3. It's which of those 3 are you willing to trade off to get at least something to invest in. The beautiful part about Southeast Asia is that you do indeed get all 3. We see a very attractive opportunity to build what we think will be the next roughly 10 to 20 large cap public companies from Asia. The proof is in the pudding. You've got approaching 700 million people, historically quite fragmented, increasingly addressable as a unit, often from Singapore. You've got a new breed of companies that are going public. For example, the best performing Asian tech stock in 2019 wasn't a Chinese company or an Indian company or a Korean company. It was a Southeast Asian company that tripled. It was C. And I think most interestingly, you've got almost a 10-year advance visibility on what are likely going to be major categories that produce large public companies. Because you can look at China, which is exactly 11 years ahead of us in terms of affluence, and you can see a litany of 150 companies that are now public, and you can actually very precisely map the ones that don't yet exist in Southeast Asia. Now, you may make an assessment that some of them will or won't exist, like China, but if even half of those companies exist, the future is going to be very, very bright. So I really applaud entrepreneurs like Amit, who's one of our portfolio companies, on what they're doing. It's a company, and I won't steal his thunder, that has managed to grow across not just 1, but 5 countries simultaneously, and is able to double almost every 8 to 9 months at scale. So that's really the message on Southeast Asia, an underappreciated, arguably neglected market, but at the same time, great economics, great fundamentals, and great growth.
Well, I want to go to Amit and have him talk about RedDoorz. Tell us what RedDoorz does and what prompted you to start it, why you chose Indonesia to really grow out first, and about your expansion into Vietnam and Philippines and other places.
Yeah. Thanks, Rich. There are 180,000 of these mom and pop owned two-star kind of properties. Each entrepreneur has one or two properties. They invest in those properties or hotels because they think it's an easy business, it's a great way to conserve capital, and real estate is very good, right? And so over a period of time, we have a lot of this inventory which has come up, and then the consumers have become far more smarter than property owners. And so property owners are struggling to manage the new breed of consumers. And so RedDoorz came up as a affordable network of hotels which would franchise the RedDoorz name, give them the technology, and then the way to look at it is we are like the Marriott of two-star hotels, but we are like on technology on steroids. And so building one hotel at a time, we now have 1,800 plus hotels in the 4 countries which we operate in.
And proof of, well, a couple things. A lot of people forget how big Indonesia is. I mean, almost 250 million people. And so when you look at building a model that you wish to scale, Indonesia is a pretty good experimental grounds because of the local population. But it also shows that for a lot of businesses, global scale is a fiction because they don't understand the local market and the local market conditions. And tell us about Airbnb is not doing well where you are because they're missing something about the way your market works.
Yeah, I think, you're absolutely right. Like, you can't have a global solution to a hyper-local problem. There are very few companies, maybe Booking.com has done it successfully across various markets, but there are very few companies who have managed to do that. So Airbnb is extremely successful in its own right, and it's in markets like Europe and North America, etc., and also in pockets in Asia like Bali or in Japan, where there's a lot of inbound foreign travelers. But domestic travelers don't go and stay in other people's homes. It's just not something which is done, right? And so they would rather stay in commercially run establishments. So a solution like ours is definitely more localized. It works much better. But in all fairness, they're two different kind of companies.
Mm-hmm. Oskar, tell us why you like fintech and mobility. And mobility, he means physical mobility, not mobile phones, but ride sharing and those kinds of things as investments in Southeast Asia. And sort of to your example, I mean, the local champion Grab in Singapore, the ride sharing was able to roundly defeat Uber and some of those competitors coming in. But what do you see that excites you about Southeast Asia?
Sure. So I think Nick very much put it in the right words. It's all about growth, opportunity, huge populations like we see in Indonesia, Malaysia, outside of China, obviously. But fundamentally, an overall population that's very digitally savvy. People are connected to their phones, are leaping forward and bypassing certain elements of infrastructure. And therefore, with, I guess, relatively poor traditional infrastructure in some countries, namely logistics or roads or places that are geographically challenging, such as in Indonesia with all the islands, or a capital city that's sinking right now and therefore being relocated. What you find is that there's tremendous opportunities for new business models, particularly business models where you can also avoid, I guess, elements of corruption by having transactions being digitalized from the get-go. But more importantly, I guess the trend towards the super app models, which will require obviously a lot of capital. We're seeing this, I guess, in ride sharing, starting off with transportation and now effectively branching out into all different areas of, I guess, what consumer internet through the apps can offer. Which will cost a lot of money, a lot of capital. Hence, everybody has read about the rumors about the potential merger between Grab and Gojek. But what's actually fairly impressive is that there is the emergence of these giants in emerging markets. To Nick's earlier point about, I guess, amazing companies or unicorns emerging in Asia, which will definitely teach us some lessons here in the US and which will also move or be imitated in places like Europe.
Woon, years ago on a Forbes investor cruise, we had, sort of the godfather of emerging markets. I was just talking about him.
Mark Mobius.
Mark Mobius. I think I was confused. I'm going to blame it on the backhoe. But Mark Mobius really made his name in sort of the pioneer of emergent markets. And on the Forbes investment cruise, he was most excited about Southeast Asia. And when you think of emerging markets in Mobius's terms, it's not the rawest of the raw markets. For instance, even in Southeast Asia, Cambodia would be a little early. Much of Africa, most of Africa is still a little early. But he was looking at that sweet spot when you had widespread education, you had, emergent middle classes were really growing, and then you had young median ages, 26, 27, 28. And all of that fits a lot of Southeast Asia.
Yes, it sure does. I think, to Nick's point earlier, I mean, all these economies are at a stage where they are close to $5,000 US per capita. And discretionary consumption can start to take off. And like to Oscar's point, I mean, transportation, all that, if you can use your mobile phone and pay $2 for a ride or something like that, and able to do that efficiently, you can grow companies and grow revenues quite rapidly if you can, basically serve an underserved need. So fintech is another one because the ability to get credit. Now, to the point is Vietnam has become the focus because of, firstly, the trade war, right? A lot of companies are moving facilities to Vietnam and setting it up there as a kind of counterweight to China. I think this coronavirus also accelerate that process. And a good engineer in Vietnam costs $5,000 a year for Samsung. So, it's a great savings, and they are very trainable and very educated. Median age, as you say, is under 30, and I think that that's why, to Nick's point, I think the opportunity for the next 10 years could be quite tremendous.
A couple hours before, I was in conversation with Mike Milken on this stage. Well, a year ago, I also did a conversation with Mike Milken about the state of the American dream. And I asked him, where do you find the American dream working today? And he said, Vietnam. First word out of his mouth. First word out of his mouth was Vietnam. Well, I want to switch to Nick and the rest of you, but Amit is the entrepreneur and the rest are investors. To talk about your investing style, what the size of the rounds you do, which rounds are your sweet spot. And then talk about your institutional investor base, and then to talk about, with you, Oskar, since you're the corporate venture arm of Rakuten, are you building the Rakuten ecosystem, or are you investing for ROI? And then I'll ask Amit about, since two of his investors are on the stage, about working with his investors. So Nick, Asia Partners. What rounds do you operate? How do you build out your own ecosystem of limited partners and then venture firms and banks that you invest with?
Sure. You bet, Rich. So there's a really interesting and frankly kind of puzzling fact about Southeast Asia. If you want to raise $5 million or if you want to raise $500 million, it's easy. But if you want to raise $50 million, it's damn hard. And that makes zero sense. It's almost as if you had a treasury yield curve and there were no treasuries you could buy between a 7 and 15-year duration. They just didn't exist. They all disappeared. But that's exactly the dynamic we have. So there's about 200 seed stage investors, less than $1 million, get started, GoDaddy money. Then there's about 30 different firms that are writing Series A or B investments in our part of the world. And you can imagine why that's the case. It's an easy decision for a U.S. endowment or for a large family office to throw a couple $1 million to a $30, $40 million fund. No brainer, throwaway money. And then there's about 20 or 30 different global firms, Mild Firm General Atlantic, many others of that ilk, large Chinese strategics, Google and whatever, and they play the 100 and above. We're very fortunate to occupy that middle ground, and candidly, this is objective truth, there's only 2 other firms that even look at that segment. So it's a little bit of a more rarefied air, not in terms of the quality of companies and the number of companies, lots of great high quality companies like RedDoorz, just very few investors. So we have happened to make that our niche, and we love it because companies that we look at, like RedDoorz, are typically a couple of years away from an IPO, a couple of years away from being profitable, if not even that much in some cases, and they've actually done something which goes beyond the proverbial Silicon Valley product market fit. They've achieved multi-market fit. They've made that magic work in 4 or even 5 countries. And having done that, country number 6 and country number 7 and country number 8 are going to be a hell of a lot easier. So that's the niche that we play in, and we're awfully glad that not that many other people do it.
Woon, you have...
If I may add to that, actually, because it's a very interesting point, but thinking about it, that phenomenon of the early stage capital versus sort of the late stage capital, and by the way, at Rakuten Capital, we do invest in growth companies, so Series B, B2D fundamentally with checks ranging from 1 million to a couple of hundred. But what Nick was alluding to, it's probably a phenomenon that not only happens in Asia, and even see that in very developed economies like Japan, where it's easy also to get early stage capital, and then companies that go public way too early, but also in Europe. Outside some markets like the UK, it's the same thing. So that's a void that actually through some government or government initiatives, some countries are trying to fill that gap. But that's where the opportunity is, to precisely take some of these great opportunities, great companies such as RedDoorz to the next level. And I guess that's why we co-invest.
That's exactly right. And Rich mentioned Mike. So what's maybe a little known fact about Mike Milken's career is that very early on in the maybe probably was the 80s, he read a study written by this guy that had gone through decades of bond ratings and NPLs. Literally, 1900s, 20th century, whatever, long data set. And the guy concluded that yes, indeed, double B, single B, triple C bonds, they sure are more risky than investment grade, but net off the NPLs, they still make you more money. And that was, of course, the genesis of the junk bond, the high yield market. Mike did the research and figured it out. Interestingly, in the markets that Oskar mentions and Southeast Asia, growth equity has higher IRRs than early stage venture. But that's an asymmetry of information that hasn't yet percolated out. So it's puzzling to us, but also very lucrative.
Then why are you here letting the secret out?
You made me, Rich.
You should be hoarding it. Woon, you have worked with 300 institutional investors. So does that mean you're investing mostly in public companies?
Yes.
Well,
basically, if you look at, I've been involved in investing in Asia for the last 30 years. And in the last decade, there were a lot of interest to visit China to find investments that become the next Alibaba or the next Tencent. And a lot of them are being invested, as Nick said, about 150 or so of them by US investors. In the last 3 years, I've done twice a year trips to Southeast Asia, especially to Vietnam and Indonesia, where they seem to want to find the next area of potential growth companies. And there are not many of them, because as you look at the stock markets in all these countries, they're dominated by big banks and property companies, and not a lot of growth or not a lot of new ideas. So Southeast Asia C Corp is kind of opened their eyes, and I think they are looking for the subsequent opportunities. And the roadmap is, we look at China, you can tell there are some kind of opportunities coming up, like Grab hopefully will list at some point, or So again, we actually met a number of them last November to see whether they will take some of these late-stage investments before they go public. Yeah.
Oskar, are you primarily, is your number one goal to expand the Rakuten ecosystem through your investments, or are you also, or is it getting the best return on investment that you can?
So look, it's Rakuten, by the way, not Rakuten. Rakuten.
Rakuten.
So the way we do it, or the way we're rated, is obviously based on the IRR that we generate. And even though there's a lot of talk about the success or relative failure of corporate venture capital, the way we run our fund or our investments is like any other independent VC. I mean, obviously, the synergy or the opportunity to connect with any of the 50-plus business units that we have is sort of the cherry on the cake, but you can't go and make an investment with an entrepreneur on the promise that you're going to be purely connecting the ecosystem, because if you are to look for that synergy or to woo the different business units to actually find something that is synergetic with a potential investment opportunity, that investment opportunity would have traded away by the time everybody makes up their minds. I mean, particularly in a world like Japan, which is not exactly well known for its speed, right? So we try to operate very, very fast, and like any other professional independent firm.
I'll one of these days get the pronunciation correct. Amit, when you were building RedDoorz, how did you build the capital structure? I mean, did you self-fund it first? Did you have, and then when did you invite in Nick and Oskar?
Yeah, so we started off as we self-funded it, right? I was in a company called Make My Trip, which went public, so I had a little money. I was running the hotel business for them, so I self-funded when we started. And then we kind of figured out, like, to get a decent capital structure in place, we had to literally build like a mini United Nations, right? So we have Japanese capital, we have Korean capital, we have United States capital in terms of Susquehanna and IFC, Korean Naver. Asia Partners was our led our latest Series C round, which was a $70 million round. And before that, we had Qiming from China, which led a Series B round.
Sure.
So it was a lot of hard work to actually go and reach out and meet these people and try to convince them of the story, and then kind of bring them in.
And why that United Nations strategy? I mean, why did you want the money coming from so many places around?
I didn't. I wanted the money to come in from one place, and I didn't have to go anywhere else.
Oh.
But it was a compulsion, right?
Okay.
We had to do it because there was no money available. If you see, Nick's fund is also a very recent addition to the whole ecosystem.
I want to throw a jump ball question as the last question for the panel, because we're coming to the end of our time. But that is, I've become more of a China skeptic than I was a year ago. And I begin to wonder whether the era of Chinese entrepreneurship that produced people like Jack Ma and Pony Ma and others who built these huge global companies, I wonder if we'll look back and see that was an era and the door began to shut on that, because the more you introduce a kind of an authoritarianism into the culture, the fewer entrepreneurs you're going to get, because the entrepreneurs who build big companies aren't building to occupy a little niche. They're building to overthrow some incumbency, and then it becomes dangerous. Therefore, the big winner in that, if that's correct, is going to be Southeast Asia. Any comments? But some of you may not want to be on the record for your China comments because you're doing business in China, but any thoughts?
I would say that we should not underestimate human creativity. you know, of course, the Chinese have built a walled garden, and they've had amazing companies that, in a certain way, because of protectionism, but not just because of that, because of great creativity and great technology, have risen to become very, very powerful players at global scale. But if you look at what's happening, some of these players are also being disrupted by other companies that are emerging within China. And the best example is the likes of TikTok, right? Or, well, the Chinese equivalent. Or, say, companies like Meituan in the delivery space, which are also taking on other established players. So it's bound to continue, except that we should all be very careful about what's going to happen within 5G, because clearly China is going to be winning the race if they are not already.
Well, I think, sorry.
So, Rich, I don't really agree with you on this one, right? And I could completely agree with what Oskar is mentioning, that, you know, they're extremely ingenious and they're also very fast moving. So if you look at Southeast Asia, the Chinese have moved in there pretty quickly. And they're trying to make Chinese models adapt to the Southeast Asian ecosystem, which is very interesting, because it is probably a better fit for the Chinese way of doing business in Southeast Asia. But I think that's where the other pools of capital should move in quickly, rather than, you know, to be slow. Because if it is a race at some level with like 650 million people, then the Chinese are going to win that race if others don't move in quickly enough.
yeah, I think the you know, Chinese access to very cheap capital and, you know, support from the government will always make them a pretty sizable competitor player. But to you know, some of the companies that Nick was involved in, C Corp, I mean, they've been able to compete with Lazada, for example, and win, you know, Shopee. So I think, you know, it's not a clear cut that China will always win, but as they're going to take their hits also.
Nick, you have the last word.
You bet. I'll leave us on maybe a philosophical note. A bunch of folks in the audience probably are familiar with a great thinker in the 20th century, a guy named Thomas Kuhn, wrote this great book about how the most dangerous thing in the world is a theory that's been too successful, because the proponents of that theory become powerful and become decision makers and keep replicating that theory. There was a theory 20 years ago that China tech was going to be a great thing. You know what? It was the correct theory. It was awfully interesting. But today, there are US endowments, I won't name them by name, that have upwards of 15% of their entire portfolio in China tech. Strikes me as a theory that's been so successful, it might be a theory that'll over time be overthrown. So we're here to help on that front.
Well, let's give our panelists a big hand.
Thank you.
And if you want to engage with them, you're all going to be here throughout the rest of the conference, so that's why we come to an event like this, not just for the panels, but primarily to build personal relationships, something that Jamie Montgomery has believed from the beginning and executed so well. So thank you very much.
Thank you.
Thank you, Rich.
Thank you.